Hello, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, November 9th, 2024. Hey, I hope you're doing well. I hope you had a good week last week, and I really appreciate you coming to my weekend review podcast. Hopefully, this will be helpful for you. And the format for the podcast today is first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions and all the trades that I made last week. We'll talk about when I entered the trade, why I entered the trade, what the setup was, what the confluence and combination of signals at entry and why I took the trade. And then most importantly, we're going to talk about how I am going to manage the trade going forward, how I position sized, where I place my emergency stop, where I place my end of day stop, how I'm going to take partial profits into any strength that I have on the trade. And then we're also going to talk about significant overhead resistance levels and how I'm going to exit the trade. So, it's very important in trading that you create a plan before you enter a trade so you know exactly what you're going to do. You position size correctly. It's very important to position size correctly, and I'll show you how to do that. But have if-then statements. If the market does this, I'm going to do that. If the market does that, I'm going to do this. You have no control over the market. You only have control over following your plan. And not all trades are going to be winners. In fact, a lot of them are going to be losers. But what we want to do as traders is we want to try to keep those losses small and then have a process that keeps us in a winning trade, because at the end of the day, you need some large trades every once in a while to pay for all the inevitable losers that you're going to have. So anyway, I hope that's going to be helpful to see, why I'm entering the trade, what the setup is, what the confluences are, and then how I am going to manage the trade going forward. After that, we're going to talk a little bit about trader psychology. Always the most important skill in trading, everyone, is the ability to create that plan and then follow that plan. And that all comes down to psychology and our mental state. And so it's always helpful for me to teach a little trading psychology, and I hope it's going to be helpful for you. After that, I did go down through my master watch list last night, both on the daily time frame and the weekly time frame, and I have identified some potential trades for next week. I do this every Friday. I go through all of my stock list, and I look at different companies, different markets, and I say, if it came down 2 or 3% more, we would get to a level where maybe there's multiple support levels, maybe like a 30 RSI, maybe like a 200-day moving average, but they're not there yet. And the key in trading, at least for me, is doing this on the weekends and looking at a chart and saying, ideally, if it got to that spot, that is the spot. It doesn't mean it's going to be a profitable trade. It gets to that stop, but I can tell you that if you are patient and you wait for it to come to a confluence of signals, your chances of having a profitable trade are much, much higher for sure. So I've gone down through the weeklies, I've gone down through the dailies, and I have some good ones, but they're not there yet. Remember, trading really is a game of patience, being patient, waiting for that market to get exactly where you want. And sometimes they won't get there. They'll just take off and go another way, and that's fine. Then we'll just move on to another trade. But they will get there. I promise you. And like I said, if you're patient and you wait for it to get to a good spot, your chances of having a profitable trade go much higher. So I hope that's going to be helpful for you. Get an idea of the patience aspect and get an idea of being able to locate areas that have multiple confluences that put an edge in your direction. So anyway, like I said, hope that's going to be helpful. If you find any value in what I'm teaching today or going over, I really would appreciate it if you could hit the thumbs up button. It really does help out the channel. Lets YouTube know there's some valuable content here. And if you haven't subscribed, please subscribe. I'm trying to get my subscribers up as well. So, all right, well, let's get started. I'm going to run the U.S. legal disclaimer. We'll get that out of the way, and then we'll come back and we'll get rolling. So hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding on with me. And so first trade that I had is FedEx. Now, on this initial trade, I'm going to go a little slower and just kind of break down position sizing, and I'll be a little bit more involved with it. And then as we get on to the other trades, I won't be as quick, but I just always like to start out the first one with a little bit more detail. So I did get long FedEx back here on the 15th of October. Why? Okay, well, first of all, let's talk about the strategy. The strategy is what is called a deep dip buy. A deep dip buy involves the 200-day moving average, the 250-day moving average, the 300-day moving average, and or the 30 RSI. And so the black line here, this is the 200-day moving average. This is a key level with stocks. Usually below the 250, 300 or 250 is kind of a no-go area, but this is a level, and it's just as simple as, if I'm using the 200-day as a entry, if it's holding above, then I'm going to stay in the trade. If it's below, I'm going to get out of the trade. So I took the trade here on the 15th. I could have taken it on the 14th, because on the 13th we were below the 200-day moving average, but then the next day we closed above the moving average. That was a valid place to take the trade. I didn't take the trade, but the next day it came back still above the 200-day moving average and closer to the 200-day moving average. Now, this is my line in the sand. As long as it stays above, I'm in and I'm bullish. If it closes below, I'm out and I'm bearish. So that was the trade. I entered at 266.40. So now, there's some other things here too. MACD, which is the green bars, the red bars and the green bars, it was positive at the time that I took the trade. So that just gave a little extra bonus points to the trade. So the under 200, the over 200, and then the little pullback where I got it really close to the 200-day moving average. So my risk to reward is much better here. I wouldn't want to buy it up here because my risk to reward, the 200, is very far away. So when you hear people talk about risk to reward, it really just means that you are about as close to your stop as possible, so that if it does close under, you're just going to get out of the trade for a small loss. So let's first talk about position sizing. It is very important. The way that I do it, I base it upon what my account value is and 1% of that. So let's just say my account value is $25,000. Okay, I take 1% of whatever my account value is. If it's 25,000, it's 250. If it's 50,000, it's 500. If it's 100,000, it's 1,000. Works for anything. If it's a million, it's 10,000, right? But just for this example, let's use $25,000. So I take $25,000 and I divide it by the value of the 2 ATR. Right now it's 1035. So whatever it is on the day that I take the trade, it was different back when I took it, but let's just say it's 1035 divided by 1035. That tells me to buy, well, that didn't work, 250, sorry, 25,000, 1% is 250 divided by 1035. It's going to tell me to buy 24 shares. Okay, 24 shares. If it were a $100,000 trading account, 1% of that is 1,000 divided by 1035. Tells me to buy 96 shares, right? But let's get back to the 200, the $25,000. 1% is 250 divided by 10.35. It's 24 shares. Okay, so The reason the 2 ATR is so important, it measures the volatility. It measures the expected average true range. And the average true range that what I'm using is 2 times whatever the average true range is. So it should not go down 2 ATRs. I mean, it certainly can, but the good news is it only happens about 5% of the time. The other 95% of the time, if you have a loss, it will be your end of bar stop. So I position size correctly based upon my account size and the average true range, 2 times the average true range. And so I enter here 266.40. Now, the first thing I want to do is go back to my average true range, 1035, and I place that exactly below my entry by $10.35. So if the trade really goes against me and moves all the way down $10.35, how much have I lost? I've lost the $250 because I did the math. Okay, so that's how you position size. But like I said, the good news is only 5% of the time are you going to hit your 2 ATR emergency stop. 95% of the time, if you have a loss, it's going to be your end of bar stop, which is a close below the 200-day moving average. So if the next day had it closed below the 200-day moving average, I simply would have gotten out for a very, very small loss. And if you have a loss, like I said, 95% of the time, it will be your end of bar stop, not your emergency stop that hits. And so if the next day it closed below and I gotten out, well, if the next day after that it goes back above, I could get back in, right? So the risk to reward is very good because I'm very close to the 200-day moving average. So the reason I bought the trade again, close under, close over the 200, position size correctly, taking 1% of my capital, dividing by the value of the 2 ATR, placing my emergency stop 2 ATRs below my end of bar stop is simply a close below the 200-day moving average. Okay, so as soon as I enter, I place the emergency stop. I know where my end of bar stop is. And the next thing I do is I place a level, the value of 1.5 ATRs, right now it's 776, above my entry. And that is going to be my trailing stop level. If I get to that level, now I start to tighten things up because I don't want to give back all the gains that I have, okay? And so I place this here at 277.40. Now, the position sizing correctly based upon the volatility in your account size, the end of, or the emergency stop, the end of bar stop, getting into trailing stop mode, these are all defensive moves. It means that if something's going against me, I'm going to take action and get out. These are defensive moves. But I also like to play offense in my trading, and that comes in the form of taking partial profits into strength, or in other words, if it goes in the direction that I want it to. And I don't take everything off, I take a portion off, but let me explain to you how I do that. I do it every day. I take the closing price. Right now, the closing price is 286.28. So I'm going to take 286.28, and I'm going to add the value of the 0.45 to it. Right now, the 0.45 value is $2.33. So I have to do this every day. I take the closing price of all my positions. Right now, this one's 286.28. Add the value of the 0.45 to it, which is 233. So 286.28 plus $2.33. My first profit target for Monday will be 288.61. Then I take my first profit target, 288.61. I add the value of the 0.45 to it again, plus 233. Second profit target is going to be 290.94. That will be my second profit target. Then I take my second profit target, add it one more time, plus 233. My third profit target is going to be 293.27. And so what I do is I put a limit order in for 10% of the remaining shares that I have. So if I had 100 shares, for example, I would put one limit order in at the first profit target for 10 shares. The second profit target I would also put in for 10 shares, and then the third profit target I would also put in for 10 shares. And if you have a really good day, maybe you hit one, maybe you hit two, sometimes you hit three. I think I've hit up to 7 in my career, but I generally just place 3 because it's it's kind of unlikely that's going to hit more than 3 profit targets. But that is taking selling into strength. And it's it really helps everyone because one, you're locking in some profits that the market can't take away from you, and you're reducing your position size. And there's kind of a magic when you start reducing your position size, because the smaller and smaller and smaller the position size that you have, the less stress there is and the more likely you are to follow your trading plan. Okay, so let's start back with the trade. Under over 200, I bought at 266.40. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the 200-day moving average. I placed my trailing stop level 1.5 ATRs above. And next day moves up nicely. It moved up nicely enough that I hit 2 profit targets. So I've taken that off into the strength. That's the offensive part. Next day, we move up again. I can't remember if I hit a profit target here or not. Then we had a bit of a down move, but we stayed above the 200-day moving average, which kept me in the trade. And then the next morning, I can't remember why, but we had a huge gap up, which was nice because on this huge gap up here, I took more uh, uh, partial profits. I put more partial profits. I think I hit 3 profit targets on this particular day. Reduce the position size, lock those in, but I also got to trailing stop level on this day. So all this means now is that in the future, if I get a close below a previous bar's low, I'm going to get out of half of the position. And that happened here on the 4th of November. First close below a previous bar's low after reaching trailing stop level, I took off half of the remaining shares that I had. Next day, right back up, took some more profits. Next day, right back up, took some more profits. Next day, right back up, took some more profits. And on Friday again, I hit another profit target. So now I'm really starting to reduce my position size. We are at a 66.06 RSI level. So whenever I get to a 65 RSI level, then I have another net mechanism that kicks into place, and I use a trailing stop. The 5 EMA here, this thin blue line, this is my trailing stop level. Because we've hit 65 or higher on the RSI, if it closes below that 5 EMA, I will be completely out of the trade. That's the rule. And uh, if we head up, we're at 66.06. If we reject the 70 RSI level, so if we go up, hit the 70, reject it, I will take off half of the remaining shares, and then after that, if I have a close below a previous bar's low, then I will exit the entire remainder of the position. So I know it sounds like I have a lot of rules here, and I do, but the rules are there for your safety and to help you lose um, less money and make more money. And I've been trading for 29 years, and every single rule I have, there's a reason that I use it. And you'll see in some of the trades that I have coming after this trade that you'll see how those rules really helped me mitigate losses and or make more money. And I guess it's a good time to mention that I do teach private one-on-one lessons in the evening time via Skype. I love to teach. I've taught people from all over the world. I teach a 15-hour course where I teach you all 7 of the different trading strategies that I use, all the rules. We go over all of them in detail. That's why it takes 15 hours to take this course, but it's a great course. You'll learn a lot. You'll learn a skill. And if you're interested, just my email is in the link of the description. Just send me an email. We can have a telephone call, get to know each other a little bit. And it's not a sales call, I promise you. It's just to get to know and see if we would be a good fit. But it's a great course, and I know you'll be happy that you take the course because you'll be a much better trader. So right now, FedEx, the remaining shares that I have on that deep dip buy, up 6.87%. So nice little trade there. All right, let's get on to the next trade, Rio. All right, Rio. Now, Rio is a different trading strategy. It is what is called an island reversal. Island reversals, abandoned babies, exact same strategy, just a baby uses one bar, an island reversal uses two or more bars. And if you'd like to learn more about abandoned babies or island reversals, go to my YouTube channel. There's a in the lessons playlist, you can see a video that describes in detail. Oh boy, I am sorry. I drew this because it was an abandoned baby, or this was an island reversal, but my apologies. No, I'm in the trade. It's just that this trade is a deep dip buy again. Sorry, I drew the island reversals, so it made me think it was an island reversal trade, but it's not. It's a deep dip buy again. You can see the black line here, the 200-day moving average, the black line. Well, we came back down to it. We went under during the day, closed back above it. At the end of the day, gives me a very, very good risk to reward ratio. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average. I place my 1.5 ATR trailing stop level above. Next day goes under during the day but closes back over. Keeps me in the trade because I base these all upon closing prices. Next day we moved up nicely, took some profits. Next day we moved up again, took some more profits. Next day moved up again, took some more profits off the table, got to trailing stop level. Now I'm in trailing stop mode. Next day, we had our first close below a previous bar's low after reaching trailing stop level. So I took off half of the position for a gain of 2.17%. The next day comes down, but holds the 200-day moving average. Next day gaps up, hit another profit target. We move sideways, we move sideways, we move sideways. On Wednesday, came down, tested the 200, held above. On Thursday, huge gap up, and I hit 3 profit targets on this move up at this very, very high price. And you can see, am I glad that I did that? Well, look what happened Friday. Gave a lot of it away, basically back to my entry price, right? So you can see why taking these partial profits when I have them, am I glad that I did? Well, I certainly am now, for sure, especially the 3 profit targets that I hit on Thursday. So you can see how taking partial profits can really be helpful. I mean, right now it's basically break even. It just barely closed over the 200-day moving average, which kept me in the trade. Had it closed under the 200, I simply would have been out. But would I still have had a profitable trade? Of course I would have. Even though it's basically at the price that I bought it at, it's still a profitable trade because I took the profits, the trailing stop level, sold into the strength. So this is, well, this is basically break even. So if we close below the 200, I'm out. If we gap up on Monday for whatever reason by the value of 0.45 ATRs, I'll take some more profits off. So basically this is break even. The remaining shares are break even, but the overall this trade is up nicely because of the different methodologies and the different rules and the taking profits into strength. India. Okay, this one is an abandoned baby. It's down, unfortunately, but this is an abandoned baby. Abandoned baby is when you have, abandoned baby has one bar. This is the bar in blue. We gap down. Okay, so for whatever reason, overnight, the sentiment of the market was very bearish. However, the next day we gapped up. So we went very bearish to very bullish at the open. And generally, obviously not all the time because this one is down, but more times than not, when you have this abandoned baby, and like I said, go to my YouTube channel, you can see the video on abandoned babies and island reversals. More times than not, when you gap down and gap up and you go out into the future, more times than not, it will be higher. And less times than not, it will be lower like it is. So on this particular strategy, what I do, I don't take partial profits and trailing stop levels and so forth on this particular strategy because it's generally so strong. What I do is I place a 2 ATR stop and a 4 ATR profit target. So one of two things is going to happen. I'm either going to lose 1% of my account or I am going to make 2% of my account. And the key is, like I said, with this particular strategy, in my experience, about 70% of the time I hit my 4 ATR profit target. Only about 30% of the time do I hit my 2 ATR stop. And you can see I drew my emergency stop down here, 54.19. It is very close. There's just a limit order in, or stop order in there. If it gets there, I'm just out of the trade. And that's one of the 30% where it didn't work. So I'm holding on by a thread on this particular trade. This one is down at the moment 1.57%. So very close to hitting that Monday morning. If it's at that price or below, I'm simply going to get out for the loss. And if it magically turns around, gets up to my 4 ATR profit target, then I'll take it. But it doesn't look too good right now. XLV. Okay, XLV is back to the deep dip buy. I did buy XLV on the 5th of November. Why? Again, this is a deep dip buy. Black line is the 200-day moving average. Previous day, we closed under the 200. On the day that I bought it, we closed back above the 200. I got in at 147.87. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average. I placed my trailing stop level 1.5 ATRs above entry. I bought it. Next day, boom, opened up biggie bigs, right? And I can't remember how many. I think I hit 3 profit targets on this open. So right away, 30% of the trade, I took off at that nice profitable level. Then it reversed, but it did hold the 200-day moving average, kept me in the trade. Next day, moved up, thankfully, took off some more profit targets. And then Friday had a nice day up and hit 2 profit targets. So this trade's doing great. I mean, it is really doing great. I'm at trailing stop level, which means now if I have a close below previous bar's low, I'll get out of half. But again, taking these profits, partial profits when you have them, really works well for me. And this particular trade at the moment, the remaining shares I have up 1.57%. And then Boeing. All right. So I did buy Boeing here on the 6th of November at $147.20. Why did I do it? Well, 2 confluences of signals here, but the green box here, this is what is called a bullish order block. This is, again, something that I teach in my courses. And a bullish order block is simply taking the lowest close. This was back here on the 10th. This is the lowest close before we change structure to the upside. And we have been in a bearish market structure, but here on the 21st, we took out this swing high. This put us back into a bullish market structure. And so when you change from a bearish market structure to a bullish market structure, you generally want to buy the dips, and you want to buy the dips back into the order block. And so you can see here, as it came back into this green area, any place in here was legitimate to buy. But the reason I bought it here on the 6th of November, well, for 2 reasons. One, we were pretty low in the order block. And 2, there's a long-term trend line here that I drew. Where did it go now? Here it is. A long-term trend line that I drew here, that on the day that I bought it, we tested below it, came back above it. In addition to that, we are low in the order block. And so I position size correctly here. My emergency stops 2 ATRs below. Sorry, I didn't draw that. My end of bar stop is simply going to be a close below the bottom of the order block here. Here it is, lowest bar close, low 146.30. That is my end of bar stop. So next, and then I place my 1.5 ATR trailing stop level up here. So I got in at 147.20. Next day we move up nicely. Did hit a profit target. We're not at trailing stop level yet. but we are profitable on the trade, and so far this particular trade up 3.04%. But again, the reason for getting in the trade, we were in a downward market structure. We broke to the upside. Once we break to the upside, the order block is the green area. We came back down. We not only did we close in the order block, reject the bottom of the order block, but we rejected this trend line here. So that's why I took the trade. And like I said, up 3.04%. Once I get to trailing stop level, then in the future, if I get a close below previous bar's low, I'm going to be at half of the trade. So those are the open positions. The current open positions, FedEx up 6.87%, Rio just about break even, INDA down 1.57%, XLV up 1.57%, and BA Boeing up 3.04%. Okay, so let's go to the closed positions. This is UUP. This was a short position. Didn't end up good on this one, but I was talking about island reversals. I got short here the dollar 29.28. Why? Well, here on the 23rd, we gapped up. So we gapped up. Everything was bullish. Then we immediately gapped down. Okay, like I said, more times than not, when that happens, you're going to look off into the future and it's going to be lower. But this one, no. So what I did was I got short here at 29.28. I placed my emergency stop up here, my 2 ATR stop up here, 29.54. I placed a 4 ATR profit target down here. Remember, you want to have a good risk, or you want to have an asymmetrical risk to reward ratio. I'm risking 2 to make 4, and this one just didn't go my way. Initially it did. I got short here 29.28, kind of hung out, then we broke down, started to move my way nicely, but then of course with the election it changed everything and it gapped up here. It actually gapped up higher than my stop, and that can happen. My stop was at 29.52. I got out at, it opened at 29.60, so I actually lost a little bit more than 2 ATR on that particular one, and that definitely can happen. And so this ended up being a loss of 1.15%. And then we gapped all the way back down. I was like, gosh dang it, it just happens, right? And then we were up again on Friday. So this was a losing trade here with the abandoned baby for a loss of 1.15%. WBA. All right. This was also a loss, but a very small loss. This is what is called a return to value V1 or V2. Let me point your attention to this green line and this green line. This is what is called the value zone. In general, I like to buy below the value zone, sell in the value zone, or I like to buy in the value zone and sell above the value zone. But this is another one of the approaches that I use and that I teach, and I love this particular setup. Doesn't happen a lot. I think I mentioned last weekend that I haven't seen a legitimate return to value V1 or V2 for a long time, but it happened. So the first rule is we need to close above the value zone, above the green line, which we did. We came back into the value zone. We had sideways motion, which we needed, and then we had a V1 entry trigger. A V1 entry trigger consists of 2 bars, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. So I position size correctly. I entered at 941. I placed my emergency stop 2 ATRs below. And then your end of bar stop on a V1 is halfway of the second bar, halfway the washout bar. We call it the washout bar because it washed out or went below the previous bar's low. Place my 1.5 ATR trailing stop level here. And then we move sideways, no profit targets. Here on the 4th, we came down, but we held above halfway of the washout bar on a closing basis. The next day, we went open below, went down, reversed back up. Things were looking better again. Then on Wednesday, we gapped up, luckily, gapped up enough to take a little profit off. And then on that same day, on the same day, we closed below halfway of the washout bar, and that was my um, rule to get out of the trade for a loss of 1.95%. So they're not always going to work, but the key is you just have a good risk to reward ratio, which I did, and then follow your rules. Did it close below halfway? I did. Story's over. I just get out of the trade. I can always re-enter at a different area, but this one was a loss of 1.95%. All right, AGQ. All right, well, this was a really big trade for me, and I've shown you some abandoned babies this week. A lot of abandoned babies this week that did not work, but this one worked really, really nicely. You can see the red bar up here. This is a bearish abandoned baby. Why is it a bearish abandoned baby? Because we gapped up, and the very next day we gapped down. Now I waited for to get short when it came back to the bottom of the abandoned baby. I generally, when you have an abandoned baby that goes up and down, I generally don't short there. Sometimes I miss it and it just keeps going down, but I wait for it to get back up to the bottom of the abandoned baby. So I did get short here, 48.40. Again, this is a either or. I'm either going to hit my 2 ATR stop or I'm going to hit my 4 ATR profit target. And this one was great. It nailed that top on Wednesday. It hit my profit target, my 4 ATR profit target. Remember, I'm risking 2 ATRs to make 4 ATRs and nailed it. So that's the nice thing. You know, you only have to, you can have, with this approach, you can have 2 losing trades and then 1 winning trade and you're even. But it's better than that because it wins more than 50% of the time in my experience. So this was a really, really nice trade on the abandoned baby, 23.11%. Remember, you're going to have a lot of losing trades, everyone. You are. Even the best traders in the world have a lot of losing trades. But the key is get out of those quickly. Be very impatient with your losers. Be very patient with your winners. And it's fortunate that that abandoned baby really worked, and for a gain of 23.11%. And then TLT, another abandoned baby, and this one did not work out, but it was a pretty small loss. So back here on the 29th of October, we had a gap down, we had a gap up. This generally is going to signify that in the future you're going to be higher. I got short here, 92.30, placed my 4 ATR profit target above, my 2 ATR profit stop loss below, and then we went down. Things were going down. Then we rallied, but then on the election day, with the election results, it changed everything for everything. I've never seen quite a week like this, and I did hit my emergency stop. Actually, even more. It opened below, so I had to get out. So I had to take a loss of 2.88%. Not fun, but I have to do it. But I know if I keep doing this over and over and over, more times than not, I'm going to hit my 4 ATR profit target instead of my 2 ATR stop, like I just showed you on the silver trade. Okay, so that is the closed trades on the daily. UUP, a loss of 1.15%. WBA, a loss of 1.15%. WBA, out for a loss of 1.9%. AGQ, a gain of 23.11%, and TLT, a loss of 2.88%. So really interesting week, everyone, really. I mean, it had some good trades, had some bad trades, overall good. But when you have an election and a surprise kind of election like this, it really does things to the market, which of course you saw. So those are all the daily trades, the open and the close. Let's quickly go to the weekly trades. Now I take weekly trades on Friday. That's when the weekly bars close. And so this is Adobe. I entered this just Friday. I entered this yesterday. Why? Well, I've been talking for weeks about Adobe getting down to this green area here, but what I was really looking for was this blue area down here. And you can see we got very, very close. Why here? Well, this purple line here, this is the 250-week moving average. That's what I was looking for. And I said last week, I said, if it goes down and rejects the 250, I'll potentially get in there. Or if it heads back up and has a close above the 200, I'll consider doing that as well. And that's what I did. Not only did we have a close over the 200, which is a weekly trade, we also had a V2. V2 consists of 3 bars, bar 1, bar 2, bar 3, bar 2 goes under bar 1's low, closes above bar 1's close. So that's the confluence, right? You always want to look for confluences. So the confluence was an under over 200, which is the deep dip buy, and then we also had a V2, which increases the chance of having a profitable trade. So I entered at 494.68, which is exactly where it is. Oh, I didn't even enter. Well, it's a good experience. I'll show you. So right now, the 2 ATR is 58.40. So I take my entry price minus 58.40, way down there, isn't it? Let's see, it's going to be about right there. There we go. That is my emergency stop. If it gets all the way down there, how much will I lose? I'll lose 1% of my account. Like I said, only 5% of the time is that going to happen, but I need to know in the worst case scenario exactly how much I'm going to lose, and if I do get down there, I will lose 1%. But that's my emergency stop. My end of bar stop is a close below the black line, below the 200-day moving average. And so next week, if it closes below there, I'll simply get out for a much smaller loss than the emergency stop. And then the 1.5 ATR trailing stop level is up here, 43.80, so right a little higher than that. That is my trailing stop level. If I get to trailing stop, then I go into trailing stop mode. But right now, the key thing that I am looking for is to stay above this 200-day moving average. Right now, the 1.5 ATR trail, or the partial profit, the 0.45 is $13.14. So back to taking profits into strength, 494.68 plus 13.14, whatever that is, that's my first profit target on Friday. I'm sorry, for next week. So I'll place 3 of those. So if it does head up and get to 1, 2, or 3, I'll take partial profits. If it gets to trailing stop level, I'll go into trailing stop mode. If it closes below 200-day moving average, I'll simply get out. If it just crashes down and hits my emergency stop, then I know what to do there too, right? So I have a plan. Regardless of what happens, I know exactly what I'm going to do, and I would suggest that you do that for yourself and your trading. So no matter what happens, there's not one scenario that can happen that you don't know what to do. And like I said, I teach private lessons, one-on-one lessons. I'm very happy to help you and get you to have your own exact plan so you know exactly what to do. Okay, so even on this particular trade right now, I got it right at the close, completely even on this trade, new trade. Disney. Okay, Disney is a deep dip buy that I bought all the way back here on the 9th of August at 85.90. Why? Well, on this particular bar, we went under 30, over 30 on that particular, at the end of that week. That was my trigger point. That was the entry signal. I got long 85.90. My end of bar stop was a close below 82.95. My emergency stop is all the way down here, 76.50. I placed my 1.5 ATR trailing stop level above. And then, of course, if it moves up the value of 0.45 ATR, I'm going to hit profit targets. Next week, it did move up. I hit some profit targets. Then for a couple weeks, it moved up, didn't do much, came back down. Obviously, no profit targets. But stayed above my stop level. Then the next week we moved up nicely, took more profit targets, got to trailing stop level as well. We have not had a close below a previous bar's low since then. And then, of course, this week I did hit a profit target. And you can see the 0.45 ATR right now is 181. It was up $3.21. So of course I hit a profit target. So we have earnings coming up. I never hold through earnings. And so I will be out of this trade before earnings. This particular trade though, doing quite well, up 13.01%. And again, I will exit before earnings. And then last trade was QLD short. This was a really bad trade. Yeah, just didn't work, because of the election. I did short QLD here at $100.20. Why? Well, notice the red box here. This is an order block. This is your highest close before market structure changed to the downside. And if you change structure to the downside, generally you want to short the rallies back into the bearish order block. Well, that's what I did. I shorted here $100.20. My stop was a close above the high of that bar at 103.12. And for several weeks, initially went down. Then for several weeks, it tested that level 103.12, rejected it, came down, rejected it, came down. The week before last, went down, actually got into the money on the trade. But again, with the election and the results, we just had this huge move up here and had to take a loss, had to get out. Wasn't fun, but I have to follow my rules for a loss of 9.16%. I haven't had that big of a loss percentage-wise in a while, but did not get to my trailing or did not get to my emergency stop. Did I lose 9.16% of my capital on the trade? No, I didn't. I probably lost about 3/4 of a percentage because the way I position size, if I got to my emergency stop, I'm going to lose one, right? So, all right. So those are the weeklies. Adobe, exactly even. Disney, a gain of 13.1%, and then QLD, that stinker, a loss of 9.16%. So it was an interesting week overall, good and green, but usually my trades are a little bit more consistent than this. But because of the election, it just threw things really out of whack. But all in all, good. Grateful for that. All right, before we get on to looking at next week's potential trades, let's talk a little bit about trader psychology. This is from Trading Composure. You can follow him at Trading Composure over on Twitter or X. I really like this saying. It's very important. If you run out of capital, it's game over. Don't run out of capital. All in is what mindless gamblers do. Be different, focus on survival. And this says so much, everyone. Really, trading is about focusing on survival. It's about preserving the money that you do have. It's about having a plan, creating a plan, following the plan, being very impatient with winners. Being very impatient with losers, being very patient with winners, and staying in the game. If you start trading and you lose all your money, well, you're you're out, right? How are you going to get better? The more you trade, the longer you trade, the better you're going to be, but that all goes away if you lose all your capital. So, I'm just telling you from the heart, everyone, have that plan, set that plan, be patient with your winners, be impatient with your losers, and stay in the game. One more time, if you run out of capital, it's game over. Don't run out of capital. All in is what mindless gamblers do. Be different, focus on survival. Focus on survival, focus on staying in the game, position size correctly, and never go all in, right? Don't ever go all in. I don't care how good the setup is. So anyway, thank you, Trading Composure. Appreciate that. And now let's get over to the potential trades for next week. Okay, so here I have nine. These are the dailies. So here I have nine potential trades for next week. Again, I say this every week, but it's possible that all nine of these could trigger all on the same day. So at that point, I have to decide: am I going to take all nine trades, or am I only going to take one trade? Well, you know the answer to that. I only take one trade. I always narrow even if I have 9 legitimate setups, I narrow it down to the best one of the day. It's just a rule that I use. It's worked well for me. I just like to take the best one of the best, even if all of these trigger. And so what I do is I kind of allocate a score. Just for example, if Apple had one signal, maybe that's 1 point. Maybe Caterpillar had 2 signals. Maybe Cameco had 3 signals. Which one would I pick? Well, of course, I'd pick the one with the highest score. I'd pick the one with 3. It doesn't mean it's going to be a profitable trade, but it just stacks the odds in my favor. So I look at how many entry signals and confluences of signals are there, which one looks best on a higher time frame, which one has the best risk to reward ratio, which one is weakest or strongest relative compared to the rest of the market. Um, this is what I teach my students in my trading. I mean, the devil's in the details with trading. It's not just looking at one thing. Risk to reward, multiple signals, higher time frames, relative strength. And again, in my one-on-one course that I teach, this is what I teach and how to differentiate and pick, and it's a very valuable skill. So if we look at Apple right now, it's not where it needs to be, but you can see I have this red box here. This red box is a bearish order block. Why does it in an order block? Well, because when we move down here, we took out this swing low here, which actually, even though it's going up, bigger picture, it is in a bearish market structure. So if you're in a bearish market structure, I want to short rallies. Well, the order block between 234.47 and 232.29, the high and low of this highest bar close before the market structure change, this is the shortable area. In addition to that, we have this long-term trend line here that bisects. You see how it goes right through this order block. So there's your confluence of signals, is in this area here between about 234.30 and 231.96. Ideally, what I'd like to see, and with these particular order block trades, if you just get to the order block, okay, that's legitimate. Technically you can short just right there, and I may do that. If we get right to the bottom of that order block and head back down, I may get short there. Ideally, I'd like to get higher in the order block and see a rejection of that trend line. That would be the ideal for me. So I'll probably wait for the ideal, because the higher I am here, the better risk to reward ratio I am here. So I am looking for a short on Apple somewhere between 234.47 and 232.29 in the bearish order block, and ideally if we could reject the trend line as well. So I'm looking for a short potentially on Apple next week. Caterpillar. Okay, well, this is a good example of a island reversal. I've talked about abandoned babies. Abandoned baby consists of 1 bar. Island reversal consists of 2 bars. You see how we gapped up. We had the second bar, and then Friday we gapped down. So we went from very bullish to all of a sudden very bearish. Now, could I short here right now? I could, but I don't want to. I could short right here, place a 2 ATR, 4 ATR profit target below, and a 2 ATR stop above. And I may not get this, but the ideal place to short this is at the bottom of the island reversal. And the low there is 404.01. So I want to see a little bit of a check back into that resistance area, just like I did on the silver trade, on the AGQ double leverage silver trade. So a move back to 404.10, I'll just have to see what it looks like when it happens. But that would be my shortable area, 404.10. Right now we're at 393.37. And what would I do if I do take this trade? 2 ATR stop above, 4 ATR profit target below. But it's valid right here and now. But generally when you get this, you'll get a little bit of a move back up before you head back down for a longer leg. At least that's the idea. So that's what I'll look for. Potential rejection there of 404.10 next week to get short. Cameco. All right, so Cameco, this is simply a deep dip buy. You can see here's the black line, here's the 200-day moving average. This is the key. It's not even close to the 200-day moving average. So is it likely I'll take this trade? No, but this is a good example of looking and going, okay, let me look at this chart. What would I like about it if it got to a certain area? Well, I would like the 200. Last time it respected it, look, closed under, closed over, had a nice move up. So if it moves back down to the 200, have a close under, closed over, an intraday rejection, or a bounce, then I would consider taking it. That 200 gives me a good structure. Bullish above, out below, right? That's it. And in addition to that, what drew my attention to this particular setup, see the gray line here? We have the gray line and the black line. When the gray line passes over the black line, that is what's called a golden cross. And what I've noticed in my 29 years of trading is when you have a golden cross, if it moves back to the 200, the first move back to the 200-day moving average after the golden cross is generally a very good time to buy something, and you generally get a pretty good bounce out of that. This is a long-term bullish indication when you have a bullish cross. But I've also noticed that once you have a golden cross, you generally come down first before you have a big move up. So because of the golden cross, the first pullback to the 200-day moving average after the golden cross generally tends to bounce. And so it, what are we at? 52.54. The 200 is at 47.08. You know, it's quite a long ways away, but it's just a good example of looking at a chart and going, if and only if it gets down here, that would make sense. So I don't expect it to get there, but if it does, I'll consider taking the trade. Japanese yen. Okay, well, Japanese yen had a baby, a bullish baby. Why bullish? Well, because here on the 5th of November, we gapped way down. That was the election. Next day, we gapped up. So if you gap down and then immediately gap up, more times than not, you're going to be higher than lower. Could I have bought the abandoned baby on Thursday? I could have, but just like I showed you with Caterpillar, I want a check back to the high of the baby. And the high of the baby is here about $60, 60.02. If we pull back to that area, then for one, it's lower, and for two, um, I'm not buying the extended move as much. I'm buying on a pullback, right? When you change market structure to the upside, I would rather bet on a pullback than just a continued move up, but who knows? But I'm looking potentially get long with FXY, with the bullish abandoned baby, with the rejection of that $60, basically $60 price. And right now we're at 60.55. Gold, same thing. Potential buy for gold. Why? Because on the 5th, we gapped down strongly. On the 7th, we gapped up. There's your bullish baby. And so coming down to the high of the baby at 247.40, that would be the legitimate place to get long again. And so that's what I'm looking for. Potential bullish abandoned baby if we reject 247.40. I want to take you back up to Japanese yen one more time. When you look back, look at the bullish island reversal here. Did it work? It sure did. Look at the bearish island reversal. Did it work? It certainly did. Here's a bullish. Here's a baby. Did it work? It certainly did. Here's a bearish island reversal. Did it work? Certainly did. Here's a bearish abandoned baby. Did it work? Certainly did. And so now we have the bullish abandoned baby. Is it going to work? I don't know. But they work more times than they don't. Okay, let's go to Johnson & Johnson. Johnson & Johnson, boy. You know, any kind of dividendy type of stocks, defensive type of stocks have really done poorly this last week because all the money just piled into the growth. But what I'm looking for here is a potential deep dip buy at the 200-day moving average. This is the black line. I highlighted it in green. We're at a 30 RSI level right now. That by itself is generally an oversold level, but you're getting the confluence, everyone. You're getting the confluence of the 30 RSI, 200-day moving average. You have the negative third ATR channel is here. as well. 92% of prices when you get to the negative third ATR channel tend to stop going down or go up. So you have lots of confluences here, and it's quite oversold because of the RSI level. You're getting the 200-day moving average. You have a double bottom bullish MACD divergence. Again, something else that I teach in my one-on-one course. So you have a lot of signals here. I know it doesn't look very pretty. It doesn't look very bullish, but technically we are getting to some important levels. 200-day moving average, 30 RSI, negative third ATR channel, double bottom, bullish MACD divergence. So could be a good trade. It could be a good trade, but I still need it to reject this 200-day moving average to potentially get in the trade. Coca-Cola, again, the market just racing up these more defensive dividend stocks. I mean, look at Coca-Cola. Straight up, I mean, literally, straight up, followed by straight down. And on Coca-Cola, we are to an interesting level. We are at the 200-day moving average, which is the black line. It's an inside bar. See how Friday was the inside bar of Thursday? Inside bars are important. Inside bars, if you go lower than the inside bar, you tend to go lower. If you go higher than the inside bar, you tend to go higher. But, you know, the kind of the important level here on Coca-Cola, you know, there's an old saying, if you break out of resistance, that resistance now becomes support. Well, this was back in June. We had this resistance. We broke out of that resistance. Now the tops here are going to act. I mean, there will be some support at the previous resistance, which is now support. So if you take the highs back here in June and you draw those out into the future, look at that. That support level is dovetailing perfectly with this 200-day moving average as well. So I'm not surprised that's where it stopped going down. So key, what do we do with Coca-Cola? Well, if we have a strong move up on Monday over the 200, I may consider getting long Coca-Cola there. However, the next level of support below on Coca-Cola is the 250-day moving average. And this is deep dip buy as well, 250-day moving average 300 down here as well. So we've stopped at the first support level, which is the 200. We have the 250-day moving average down here and the 300. So this was kind of like, I can't remember what stock now that was. Adobe. I was like, it either has to move higher or lower for me to get interested. Because this is an inside bar Friday, if we move up over that inside bar, I'll probably get long. But if we go down, then I'll look for rejection of the 250-day moving average. So again, this is a deep dip buy. And by the way, speaking of deep dip buys, yes, of course, I teach it in my one-on-one course, but I also have a really good video course on deep dip buy. It's 9.5 hours, 26 videos. It's very affordable. It's on udemy.com. And I've sold so many of those around the world, gotten so many good reviews and feedback. I think I have 4.9 stars on that particular course. And so if you're interested, I have a link to the Udemy website, the course on Udemy. It's in the description of this video. So that's a really good place to get started as far as learning to trade the deep dip buy, or one-on-one with me with the one-on-one course. So just waiting on Coca-Cola here. Either, like I said, it's important that we have this inside bar. This inside bar is very important because it's indecisive. But what I've noticed, I mean, look, we're coiling here. We went down, 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 and down. Now we're starting to move sideways, and each bar is getting smaller and smaller. This is coiling for either a continued move down or a move up. So if we take out the high of Friday's high, then we will have taken out the high of an inside bar and back over the 200. That'd be kind of interesting for me. But if it goes lower, I'll look for rejection of the 250. Verizon, again, these stocks right now are out of favor because the money's rotated into the growth stocks. But the deep dip buy, this is a deep dip buy again. This is the 200-day moving average here as well. It dovetails nicely with the negative third ATR channel. Doesn't mean it's, if it rejects this 250, it doesn't mean it's going to work. But again, it's a level that more times than not will hold. And even more important than that, it's just a structure. It gives you a line in the sand. If it closes under the 200, I'm out. If it closes above the 200, I'm in. And so, but I like the confluence. The 200-day moving average by itself, the negative third ATR channel. If it gets down to the 200-day moving average, will probably be in the very low 30s as well. So that adds to it as well. But I want to see the market tell me that there are no more sellers under the 200. So I want a rejection of the 200-day moving average. And then last but not least, this is a stock that I haven't talked about much, but I've been following. Western Midstream Partners, WES. Again, it's not where it needs to be. The 200-day moving average is what I'm looking for. Here's the 200-day moving average. Here is the negative third ATR channel. Those two alone together, that's a pretty good confluence. But in addition to that, there is a massive MACD divergence. What's that? Well, look at this low here. Look how deep the red bars are. This means there was just a lot of selling momentum. Then we had a rally. We went green. And now look, are we lower here than back over at these lows? We certainly are. But look at the MACD. This is very shallow compared to this low over here. Deep red bars here, small red bar here. This just means that the momentum is running out. It's not as strong as the move down here. So if you're running out of selling momentum, you're running out of sellers. The implication is if you run out of sellers that you're going to go back up. It doesn't have to happen, but again, it's adding up all the different um, signals and giving a score to this trade. Well, if we come down here and reject that 200-day moving average, reject the negative third ATR channel, and have this very, very strong and obvious double bottom bullish MACD divergence, that's a pretty high score. I mean, I know looking at this chart, it looks horrible, right? But it's coming into key levels, and the MACD shows that even though we've had a strong move down, it was not as strong as this. So that's what I'm looking for on WES as a rejection 200-day moving average. So those are the dailies. And then let's get to the weekly. I think I only have one on the weekly. Yeah, Merck on the weekly. Out of all the stocks, only one. And what is it? It's the 200-day moving average. Right now, we're at a 3141 RSI. We rejected the negative third ATR channel, which is good. But again, this would be a decent place to take a crack at Merck. Let's look back in the past. Did it respect the 200-week moving average last time? It certainly did for a big run. Well, now we're coming back to it again. Again, it doesn't mean it has to work, but next week, and it's still below. I mean, we're at 102.92. It's 94.10. So maybe it just heads up from here and don't mess with it. But um, if it comes to the 200-day moving average, by next Friday, I will consider getting in it. If it rejects it, I'll stay in as long as it's above the 200. If it closes below the 200, simply out of the trade. So that's what I have for you on the dailies and the weeklies. We'll see next week what happens, but I appreciate you being here today. Like I said, if you did like today's podcast, I appreciate if you would subscribe or hit the thumbs up button. If I can help you with your trading, I'd love to do that. Two options: one-on-one course, the 15-hour course, 5 sessions. Each session is 3 hours, so it's a lot of time, but I teach you all 7 of the different trading strategies. We do a lot of simulation trades. I don't just teach you. I teach you, and then we do simulation trades. We go through many charts, random time frames, random markets, and you have to show me that you know that you've learned everything that I've taught you, and not just saying yes, you've learned it, but you have to show me, and I'm not going to let you go until. So it's a great course. Consider it. Send me an email. We can get a conversation started. And like I said, it's not It's not a salesy thing. It's just a conversation to see if we're a good fit. And then also the Udemy course, you can take the deep dip course as well, and the links in the description. But please try to go out and do something nice for somebody today. If you could also do something nice for an animal, that would be twice as good. Animals appreciate kindness just like we do. But I appreciate you spending your time here, investing the time. I hope it was helpful. And on the way out here, I have to run the legal disclaimer. And God willing, I'll see you next week. Thanks again, everyone. Have a good rest of your weekend. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.